Joining me now is Clayton Trick. He's the head of portfolio management at Angel Oak Capital Investors. Clayton, welcome to the show.
Hey, good morning. Good to be with you again, Ashley.
Of course. So, Clayton, what are your biggest takeaways from today's PCE data?
Yeah, it came in right in line. Now, expectations have been rising for inflation. So the expectations, have gradually gotten higher, and the data came in right in line. And so that's not why you're seeing a big effect on markets, right? Treasury yields are effectively flat on the day, but they've been rising the last few days. And so expectations have been rising, but not a huge overall effect from the data. That does, I think, give the FOMC a chance to breathe a little easy that they're not, forecasting to be cutting rates, more so this year after the 25 basis point cut, and then getting a much higher inflation reading right after that. So I think overall the data was in line, which is really, really positive for bond investors.
And as you just mentioned last week, the Fed cut interest rates by 25 basis points. What do you see as a path forward into 2026?
Yeah, I mean, they effectively pulled forward their rate cutting plan, which we have been, pushing for that, if you will, right? So we felt that the market was a little behind on rate cuts earlier this year. We felt that the data would, continue to illustrate a slowdown in the labor market, and then inflation would not get out of control in the near term. And so you're finally seeing the market pricing in more cuts. And so they basically brought that forward, which we think makes a lot of sense. We've been saying the Fed's in a cutting bias, and they really need to get to a 3 handle, and they're now forecasting they're going to get to a 3 handle, by the end of this year. Next year, though, very limited cuts. So, the market's pricing in the Fed gets to about 3% as the new kind of floor over the next 12 months. But, we think the risks are kind of two-sided there. Are they going to get to 2.5% later next year? Or are they going to have to, get to 3.5 to 4 and stop there because growth continues to hold quite strong, which we've seen recently in the data. So we kind of feel like the tail risks are a little bit higher, a little bit fatter, with the Fed maybe having to go a little bit more than what the market's expecting, or a lot less. And so getting to a 3 handle is important, but from there it's going to be very difficult to predict where the Fed is going to end up by the end of next year.
All right, and I understand, Clayton, you believe that there is a gap between the Fed and the market. Why is that?
Yeah, I basically feel like they're, the market's expecting the Fed's going to get to 3%, which we think is fair, because we really think they're either going to get to 2.5 or 3.5, and they're kind of cutting it right in the middle. So we think that's kind of a fair estimate, but the FOMC is definitely being a little more cautious on cuts. If you look at the dot plot, the median dot for the end of this year is 3 cuts, right, including the one that we had last week. But a lot of dots are actually above that level. So really the more dovish areas of the FOMC as a whole, except for the newest member, are really calling for 3 cuts is kind of the limit they would go for this year. So that's a pretty big gap. The market is definitely predicting a much slower, really predicting that the Fed could be late again, and that they're going to have to cut a lot faster than what the FOMC's dot plot is predicting. So that is definitely a real risk. The market's cutting it in half, saying they get to 3%, but there's definitely a chance that they get to the mid-2s if the labor market deteriorates a lot faster next year.
And just to pivot to tariffs, late yesterday, Trump announced his latest round of tariffs on pharmaceuticals, heavy trucks, and furniture entering the country. Those will take effect, he says, October 1st. How much or how little do you think tariffs are having an impact on the markets right now?
Yeah, definitely a much smaller effect now directly on the capital markets than it was in April, right? So investors have really been shrugging off, kind of new announcements in tariffs. The cutting bias of the Fed and the taco trade has continued to kind of play out, and markets have really been shrugging off those risks. And if you look at this most recent announcement that you pointed to kick off the show, large increases in tariffs, on the pharmaceutical industry, they already have plans to, build plants here domestically over the coming years. That being said, with that announcement, that could apply more pressure for them to kind of pull forward some of that investment, which would be really good for GDP and really good for economic growth in the United States for additional investment. So overall, I think markets are fair to be kind of shrugging off these things because it does seem like what it's pushing toward is a pull forward of the investments that was already going to happen over the coming years as well. So I think that's definitely a bullish move, and not surprised that markets are kind of shrugging off any negative news there.
All right, thank you, Clayton Trick, head of portfolio management at Angel Oak Capital Advisors.
Thank you, Ashley.